A few weeks ago, I invested in a suit manufacturer. I asked them what the stock options were, and they said chicken or vegetable. I hope you like this silly options trading joke, guys. But the truth is that the options trading videos are so complicated that sometimes you need some cool jokes to feel better. Today I'll explain you pretty basic and simple options trading strategy. Put, sell it. Hi, my name is Dmitry Bonder. Hope you're doing well. Come for the investment and finance and stay because you want to learn options trading for beginners and get better idea what is sell put strategy when you are trading options. I don't want to overwhelm you with the terminology. So to use this strategy and basically to understand put selling options trading, we have to find answers on 4 most important questions. What is a put selling options trading? When should you use the put selling option strategy? When it's not the best idea to use the put selling strategy? And how to buy and sell puts on Webull or Robinhood or any other popular brokerage platform. So let's shall begin. So what selling of put options means? And to make it simpler, let's take an example with a house, not security. So if you want to sell a put for the house, it means that you sign a contract where you promise to buy a house at a specific lower price at a specific date if the owner of the house agrees to sell it. And in case he doesn't want to sell it, he will have to pay you a fine, a kind of premium. So in both cases, you win. In the first case, you buy a house at the price you wanted. In the other case, you just get paid money. Wait. Is it possible for you to lose money, you may ask? Yes. If the actual price of the house at specific date in the future will be much lower than the price you have indicated in the contract, then you still have to buy the house at the previously agreed price. Hope such a description of put selling sounds way easier than the definition I found in a Google, which says
put selling is when you have an obligation to buy the security at predetermined price from the option buyer if they exercise the option.
In other words, selling or writing a put option allows an investor to potentially own the security at a future date and at a much more favorable price. The next question I want to answer is when should you use the selling put option strategy? The first reason. An investor should choose to sell a put option strategy if their outlook on the security was that it was going to rise, as opposite to a put buyer whose outlook is bearish. In addition to the first rule, the first case, you should only enter trades where the net price paid for the security is attractive. This is the most important consideration in selling puts options profitably. The third case, use this strategy if you want to purchase shares when they reach a set price. For instance, if the stock is selling for $50 and you know that you would be willing to buy into the stock when it costs $40 or less, you could sell put options with a strike price of $40. If the stock ever drops below $40, the option holder will likely exercise the option and you will buy the shares at $40 each. The upside of this strategy is that you get to earn income from selling puts in the time before share price reaches the price at which you are willing to buy shares. The drawback is that if the price falls far below your target price, you will ultimately overpay for the shares. It's pretty simple. So let's say if in the example above the stock fell to $30 per share, you would still pay $40 per share when the option holder exercised the option, meaning you would pay more than you could have paid on the open market. However, if you plan hold for the long term, you can still earn a profit in the end as the stock gains value. Okay, now I think you want me to show a real example. How does this put selling work in practice? Okay, let's look at a put option on Microsoft. The seller of Microsoft January 18th $67 put will receive $7 premium fee from a put buyer. If Microsoft's market price is higher than the strike price of $67 by January 18th, 2022, the put buyer will choose not to exercise their right to sell at a $67 since they can sell at a higher price on the market. So the buyer's maximum loss is therefore the premium paid of $7, which is the seller's payoff. If the market price falls below the strike price, the put seller have to buy Microsoft shares from the put buyer at a higher strike price, then the put buyer will exercise their right to sell at $67. Now let me show how put selling option strategy works on Webull and Robinhood. First of all, let's check Webull. If you want to start selling put on Webull, you have to choose your stock. Let's say in my case it will be Apple. Now there are two options. At least you can buy calls or you can buy puts. And also you can buy or sell puts or calls. So in our case, we should choose puts and sell. Now be very careful how many contracts you are buying, because one contract means 100 shares. So we choose one. After that, you have to choose your execution date. This is a date when the contract expires. For instance, we can choose 29th of October, and we have to find the price that we like. Now we see that the price of Apple stock right now is $146. If we are ready to sell put at the price of $142, we have to choose this option, and in this case, we can set limit price, and we have to click this button to sell Apple put. That's how it works on Webull. Okay, but what about Robinhood app? How does it work on Robinhood? In case of Robinhood, it's even more simpler. So first of all, we have to choose stock we like, Apple. Then we have to click this button, trade Apple options, and we have to choose sell put. Choose expiration date, so it's a 15th of September 2023, and we have to choose the price. For instance, $110. That will be a price we are ready to buy. Okay, now very important part. What risk you should know before applying this strategy? Okay, first of all, leverage increases potential losses. Option strategies let investors leverage their portfolios, gaining control over a large number of shares at a low price. Most option contracts involve 100 shares of underlying stocks or ETF, but cost much less than 100 shares on their own. And leveraging your portfolio means higher gains when you turn a profit, but also it leads to a larger losses when your plans fail to pan out. So for instance, $1 change in a stock's price can be about $100 in additional losses on a single put option if the buyer exercises it. So it's important for investors to be prepared for potential large losses. The second very big risk, margin calls. If you sell put options but don't have the funds in your account to cover the cost, if the option buyer were to exercise them, your brokerage will want to know you can afford to pay for the shares you'll need to buy. Hey guy, are you ready? Yeah, just put more money on the account or we will close it. Okay, bye-bye. They will keep track of the liability created by the put options you have sold. However, there are limits on how much money a broker will let you to borrow. So don't worry, at least till some amount you will not be able to borrow $1 million or $2 million. Your broker might make a margin call, freeing you to put more money in the account to cover your liabilities. And if you can't come up with the cash to meet the call, your broker may force you to sell other investments, even for a loss, to cover the liability. Or potentially they will call your parents or your mom. The third potential risk related to this strategy, limited potential profits. So when you sell a put, the buyer pays you an option premium. The payment you receive is the maximum profit you can earn from the transaction. Other option strategies and investment strategies have much higher profit potential than selling puts. Typically, the maximum potential profit from selling a put is much lower than the potential loss if the stock falls to a lower price. And one more warning: be careful about selling options right before or after quarterly earnings announcements in the stock. Why? Because of implied volatilities, especially in the short-dated options. Implied volatilities tend to rise to go into scheduled announcement because of the potential of a surprise bid or miss to move the stock quickly. And volatilities will then decline sharply after results are announced and any resulting move in the stock happens. If you sell a put right before earnings announcement, you will collect a higher premium, but put yourself at a risk of big loss if the company misses and the stock declines. If you sell a put right after earnings announcement, the stock decline has likely already happened and the premium you receive will be lower. But anyway, selling put options is one of the most flexible and powerful tools for generating income and entering stock positions. Rather than buying shares at whatever the market currently offers, you can calculate exactly what you're willing to pay for them and then sell the put option to get paid to wait until it dips to that level. This tactic is excellent for overvalued markets, like market we live today. Thank you for watching this video. I hope you now have the clear understanding of a put selling option strategy. One of the easiest for beginners who just want to start trade options on a Webull or Robinhood or wherever. As always, don't forget to smash the like button, subscribe if you haven't already, and follow my link in the description to get a free Webull or Robinhood stocks if you open your account. Love you guys. Bye.